A storm is brewing in the agriculture sector, and the headwinds right now are aiming right at farm equipment and construction giant Deere. Deere is slumping near the bottom of the S&P 500 right now. But I need you to look here because while it is down 6.33%, it's at $480 and change. Folks, the low of the session was way worse, $470 and change. So it's definitely coming back. Now, this is what happened. The earnings report came out this morning. It was a technical beat on both earnings and revenue, but showed year-over-year revenue did take a 9% hit. Net sales also dove 9% year-over-year. The eye of the storm, Deere says, is tariffs. Executives now warning the company will suffer a bigger bruise from tariffs than originally thought. Last quarter, Deere had projected a $500 million impact for the year from the reciprocal tariffs, but today Deere upped that to nearly $600 million. Consequently, the 188-year-old company slashed the high end of its full-year outlook. But you know what? Deere has navigated through treacherous economic terrain for all these years, nearly 2 centuries. So what are its next steps? Joining me now in a Fox Business exclusive, Deere & Company Chief Financial Officer and Senior VP, Josh Jepsen. Hi, Josh. And tariffs, let's be clear, are not your only issue here, but farmers are also changing their behavior. We'll get to that in a second, but if we could, I want to start with the tariffs. Last quarter, you took a $200 million hit. Can you break that down for us? And will the current quarter be more, the same, or less than $200 million?
Yeah, certainly when we think about tariffs, there's really two big areas that we think about. One is the impact on customers, and we're seeing that with farmers today, where their ultimate concerns are they've got a big crop coming out of the ground here shortly, and where's that crop going to go and at what prices? So I think that's top of mind, and that's creating a lot of uncertainty for our customers and ultimately for demand. So, as it comes to trade deals, pulling ag commodities, pulling energy like ethanol and renewables, those are very much top of mind. If you look at what happened to Deere and from a tariff cost perspective, we did about $200 million. We saw $200 million of tariff cost in our third quarter that just ended. We expect our fourth quarter is 300, so about $600 million of cost in fiscal 2025.
Okay, so can you explain which areas the tariffs hurt Deere the most? Which countries? Because we've seen some moving targets here. President Trump has been striking deals right and left, and some countries are seeing not nearly as bad as what they had expected. And then others are seeing a little bit worse.
Certainly, and we saw that shift for us from a quarter ago to today. So if you look at the biggest impacts for Deere, it is the European Union, steel and aluminum, and then India. So those are the big three, and those would have been different a quarter ago. We would have seen the European Union and then Mexico and China. So we've done a lot of mitigation and USMCA certifications that has helped us there. But as those tariff rates have shifted, we've seen that change the impact and the mix of those tariffs that we're facing.
Okay, steel and aluminum, but I understand 70% of the components at your U.S. facilities are sourced from U.S. suppliers. 90% of the steel Deere uses is made here in the United States. And when we do look, I mean, steel has gotten a little more expensive. We're looking year to date that steel is up 4.6%. But when you have, do you have less exposure to foreign steel imports? And is it simply that U.S. steel companies are raising their prices regardless?
We've seen impacts on both sides. So certainly, as you mentioned, Liz, we've seen domestic steel prices have gone up, and that impacts us because you're right. We buy about 90% of our raw steel in the U.S. from U.S. mills, but we do import components that we buy from around the world that have steel in them, and we're paying steel and aluminum tariffs on those that derivative value. So that's been more impactful. And you think about our products, large tractors, combines, construction equipment. There's a fair bit of steel that comes in those, not just the raw that we bend and weld and do all those things with, but there's a lot of steel in the components that we purchase as well.
Let's get to the farmer picture here. The behavior that farmers exhibit when it comes to your equipment, the purchases, the rentals. You guys say that now farmers are renting more versus buying brand new combines and brand new tractors. To what do you attribute that? And we've also seen commodity prices come down in light of the tariffs here in the United States. You got to explain all of that to our viewers and why it's impacting Deere.
Certainly, I think from the fundamentals perspective, stocks to use of ag commodities are still relatively tight. We're at call it a 10-year average, so we're not oversupplied of commodities, which is positive. I think certainly the uncertainty around where do those commodities go as trade reshuffles, as trade deals are struck, or we see tariffs or reciprocal tariffs come in place. So that's really the big challenge, is the uncertainty of where those commodities go, and what you see as a result of that, and we've been through this before in 2018-19, we saw similar, our farmer customers will pause, and they'll exercise more caution and reserve optionality, and they'll make purchase decisions later, and at different times. And that's normal. We've seen that. And I think that's what we're seeing right now, as they go through this period of uncertainty. I think at the same time, we're working really hard, continuing to bring solutions, investing in technology and solutions that help our customers in a more challenging period improve their margins. How do we help reduce cost? How do we help improve yield? And even in a period where times are tough, we're seeing really good results of technology and utilization and those outcomes. So we're going to keep working really hard and getting those solutions to our customers, and we're seeing them both, upgrading existing machines and buying new and bringing those into the market. So it's a challenging environment right now for our customers. And one of the things, we've been around for, as you mentioned, 188 years. That's our focus. That's what we get up every day thinking about. How do we take care of them?
Yeah, and I would imagine your autonomous push into tractors is certainly an attractive proposition. But when farmers are hurting, they are not going to spend six figures on a brand new piece of equipment. I get that. What I do find interesting is well before the Trump tariffs. So last year, 2024, the Department of Agriculture reported that net farm income came in at $139 billion. In 2022, that number was $182 billion. So that's well before the tariffs. When you equate that to what's going on with equipment purchases and rentals, why is this number coming down?
Yeah, we've seen clearly pressure on commodity prices, and that's come through a recovery of stocks around the globe. We've seen good weather the last couple of years, which has bolstered global stocks. And like I said, we're still relatively tight, but it's come up, it's increased. The other challenge we're seeing is higher input costs for our growers. So the inputs, think fertilizers, seeds, chemicals, all those things, we've all seen, the impacts of inflation as we came through the pandemic. And a lot of those things have been stickier in the ag space and from a commodity perspective. And that's been impactful. And again, that reinforces, the work that we're doing to help our customers do more with less and be able to stretch those inputs that they're using each and every day.
Josh, thank you. And again, I do point out, over 10 years, you guys have seen a 400% increase in the stock price. And again, we're well off the lows of the session, but still, it's a tough day for anybody who owns Deere shares, down about 6.5%. We'd love to see you next time. Thank you.